Toronto's condo market is shaky, but it isn't crashing. Prices are dipping, listings keep stacking up, and developers are hitting pause, yet construction across the skyline isn't stopping. If you're buying, selling, or investing, this is the week to pay attention because the next Bank of Canada decision is just around the corner, and it can tilt the entire board. So here's the plan for today. First, a clean snapshot of where we are right now. Prices, inventory, and sales. Second, the why under the headlines and what actually changed. And third, what the upcoming Bank of Canada decision likely means for you. Then I'll give you a practical playbook for buyers, sellers, and finally my thoughts and takeaway on why this slow correction actually makes sense. So let's start with the numbers. In the second quarter of 2025, the average selling price for a condo and across the Greater Toronto area came in just under $686,000. That's down about 6% from the same quarter a year earlier. A noticeable dip, but not really a condo market crash. Sales of condos in the GTA have gone down compared to last year, but the bigger story is supply. The number of active condo listings have gone up 8%, and on the new build side, we're at the slowest pace in more than 30 years. In the first quarter alone, the Greater Toronto and Hamilton area recorded just 533 new condo sales, which is insanely low for a region this big. That tells you that very few new condo projects are selling or getting launched right now, even as completed units continue to hit the market from projects started in the last cycle. Those completed condos are being delivered to buyers and investors, which means supply keeps going up. And that imbalance between supply and sales is what's creating a condo buyer market right now. And if you're expecting condo prices to recover or go back up, this is a major reason why they won't shift much over the next couple of years. If you're a condo buyer, I have some tips on how to buy in the current market or even next year, especially if you're unsure if prices will keep falling. So in the next few minutes, I'll show you how today's slowdown actually gives you more leverage, what signals to watch before the next Bank of Canada rate cut, and the steps you can take to make sure you don't overpay even if prices dip further. On the resale side, things are softer but still moving. More listings mean more choice, and more choice means buyers can actually take their time. It's taking more than a month for a condo to sell in the GTA. Bidding wars are still happening, which might surprise many of you, but they're not what they used to be like. In a lot of cases, they're actually not working out for sellers. And prices haven't fallen in a straight line either. Buildings that get a lot of light, that have efficient layouts, and that aren't so cookie cutter, units with parking included, and reasonable fees still bring in a steady amount of interest from buyers. Older properties with high carrying costs, or those awkward floor plans with wasted space, these are the ones that need sharper pricing or better presentation to move. So in other words, it's selective gravity, not chaos. Not everything in the condo market is falling. The pull downward depends on the quality of the unit. There's logic to which condos are holding value and which ones are slipping. So why is this happening right now? Three forces. First is affordability. Mortgage rates are nowhere near from their peak periods in mid-2024, but they're still higher than that 2% range that a lot of people remember. When you run the numbers, even a quarter point change moves a typical payment enough to push some buyers to the sidelines. That little shift is enough to cool demand right across the board. The second is investor math. Rents have cooled. Average one-bedroom asking rents across the GTA are down year over year, which is the reason why we're seeing some landlords offer incentives, free months of rent, and reduced parking. So for anyone who purchased a pre-sale condo banking on non-stop rent growth is now seeing their cash flow projections squeezed. Third, supply timing. The last cycle pushed a lot of projects into the pipeline, and a lot of them are completing right now, as buyer demand is cautious. Fewer new projects are being launched, but the ones already under construction are still coming. So we're seeing finished condos hit the market just as pre-sale activity dries up. That imbalance creates exactly the kind of gentle downdraft we're living through. And that wave of supply sets the stage for the next big question. What's going to happen with borrowing costs? Because the real wild card in the story isn't just how many condos are hitting the market, it's what's happening with interest rates, which we'll talk about next. It's the piece of the puzzle that everyone's watching, the Bank of Canada. So here's a clean timeline of everything that has happened so far. In 2024, the bank started cutting rates in June, then July, September, October, and December. It cut again in January 2025 and again in March, bringing the overnight rate to 2.75%, where it's at today and hasn't been in more than 20 years, since 2004. And now more recently, the rate has held steady through April, June, and July. The next announcement is on September 17th, and there's a lot of speculation that the Bank of Canada will actually cut the rate by 0.25%. And why is that? It's because the economy hasn't been growing much. In fact, Canada's GDP fell by about 1.6%. If GDP is shrinking, it means the economy is slowing. Businesses might cut jobs and inflation pressure eases. And if GDP is already falling, the bank knows higher interest rates could make things worse. If rates don't change, how the bank talks about inflation and growth could still move the market. So what does that mean for you? With fixed mortgages, the interest rate you pay is linked to the price of Government of Canada bonds. And I'm going to try my best to explain what a government bond is. So a bond is kind of like lending your friend lunch money. You give them $10 today and they promise to pay you back later with an extra dollar as thanks. The government does the same thing with bonds, and banks watch those bonds closely. The price of bonds usually changes before the Bank of Canada makes its bigger decisions, which means fixed mortgage rates can move early, like a weather forecast shifting before a storm actually arrives. And it's a little bit different with variable mortgage rates. A 25 basis point cut is not a magic wand, but it's also not nothing. On a $500,000 mortgage with a 25-year amortization, a quarter point change shifts the monthly payment by roughly $70 a month. Let's say on $750,000, think roughly $100 to $110 a month. That slight nudge can pull buyers back into the market, especially if it lines up with a good unit at a sensible price. So if a small rate cut can change the math for buyers, what does that actually look like across Toronto's neighborhoods? Zoom in and you'll see how uneven this is across the city. In the downtown core, City Place, the entertainment district, parts of the waterfront, well-located one-bedroom units with efficient layouts and reasonable fees still draw steady foot traffic. The difference is leverage. Buyers can negotiate on price. Walk north to Yonge and Eglinton or along the North York corridor and you'll find a split market. Newer towers with awesome floor plans, those are the ones that'll move, but only if they're priced at today's market values, not 2022. Older buildings with dated finishes or higher fees might not get the same sort of traction. In midtown pockets with good schools, two-bedroom units hold their value better because more people use them as homes, not just as investments. Now go west toward Mimico or east towards Scarborough Town Center, and the same pattern shows up. Well-designed, cost-efficient units move, but the rest just sit on the market. And knowing this matters because the condo market is really a mosaic, meaning that it's not just a single uniform market moving in the same direction. Not every condo is the same. Some buildings are closer to subways and buses, some have lots of sunlight, quiet walls, and smart floor plans. Those sell more easily. Other buildings have problems like noisy elevators, money troubles in the condo budget, or fees that just keep going up. Those are harder to sell. So if the market is really a mosaic, how do you know which condos are smart buys and which ones will drain your wallet? The answer actually depends on how you approach the market, and that's where having a clear playbook really matters. If you're buying in this market, here's where you need to pay attention. Step 1, get your financing fully underwritten, not just pre-qualified. That means the lender actually checks your documents, pay stubs, tax returns, bank statements, and credit history. After the review, they say, yeah, we can lend you up to this amount as long as the property checks out. If the Bank of Canada cuts later this month, you want a rate hold that lets you benefit without redoing your file from scratch. Step 2, build your target list by building and not just by neighborhood. Not every tower is equal. Read the status certificate, or have a lawyer thoroughly review it. You can always get this document before you even put an offer in writing. Look at the reserve fund balance and the engineering reports. If the building had a special assessment, ask what changed and whether the fix was permanent. Say a condo building needs to replace 3 elevators at a cost of $1.5 million. If the reserve fund only has $1 million, the remaining $500,000 gets divided among the 400 units, let's say. That's about $1,250 per owner as a special assessment. Step 3, use conditions. Financing and status certificate conditions are safeguards, not warning signs. Keep your timelines short and reply quickly. Sellers notice when you mean business. Step 4, negotiate closing costs, not just price. A small credit for legal fees, or even negotiate down based on some of the things you might have to take care of after taking possession of the unit. Step 5, bring your flashlight and your nose. Seriously. Smell for moisture in closets, look for gaps in walls and for moldy caulking. Check balcony doors and listen for elevator noise. Look for areas where patches were made on ceilings or walls. A small leak could turn into a big bill. Step 6, calibrate your expectations. You can get value, but you still need to compete for the best units. Show up prepared and be ready to sign when the right one appears. Here's a bonus. Compare total monthly carrying costs and not just the sticker price. A slightly higher purchase price with lower fees can beat out a cheaper unit with inflated maintenance fees. Over 5 years, the math can add up. If you're planning to hold long term, look at the fee trends over the last 5 years. A disciplined condo board often saves you from future headaches. That's the complete buyer's playbook, but for sellers, the game is very different, and getting it wrong can cost you thousands of dollars. So for sellers, this is what you do. Price to the most recent comparable sales, not to your memories from like 2 or 3 years ago. Stage the unit where necessary, declutter the balcony and get windows and glass panels cleaned if possible. Replace old lighting with bright, energy efficient fixtures. Fix the little things that scream deferred maintenance, like closet doors that are sliding off the track, or a fridge that leaks water every few days. If your fees are high, lean hard into what your fees actually include: utilities, parking, strong reserves, and amenities, and have documents ready to prove that the building is well run. Ask your agent for buyer feedback after the first weekend and be ready to make a smart adjustment. Getting the price right early almost always nets you more than chasing down the market. So let's put numbers to it for a second. Take that $500,000 mortgage over 25 years. At a fixed rate of 5%, the monthly payment is about $2,920. At 4.75%, it's around $2,850. Call it a $70 drop. At 4.5%, it's about $2,780 a month. On a larger mortgage, say $750,000, the same 0.25% drop can move the needle by roughly $100 to $110 a month. Not life-changing, but definitely budget-changing. So the numbers tell one story, but psychology tells another. And that mental game can push the market further than the math alone ever could. So let's get into the mindset of buyers and sellers, because that hidden psychology is what really pushes the market. Corrections don't just move prices, they move minds. When people read scary headlines, they anchor. Buyers expect bigger discounts than the data supports, and sellers hate the idea of leaving money on the table. So they hang on to old comps, and that tug of war between buyers and sellers is what really sets the tone for today's market. So it's easy to think that the market's chaotic right now, but really it's just adjusting. More supply, less demand, so prices shift. That's the natural cycle. When you can get that, you can move forward with less fear and more confidence. Throughout the fall, watch 3 signals. First, the Bank of Canada decision and the language around inflation and growth. If the bank makes another 0.25% cut, look for a modest bump in showings and mortgage pre-approvals. If it holds, expect a slower grind as the market waits to see what happens next. Second, watch for standing inventory in completed projects. When developer held supply finally starts to clear, that's often an early sign of stabilization for resale prices. Third, watch for rents. When rents stop sliding and flatten out, that's usually when investors warm up again. None of these signals can shift the market overnight, but collectively they reveal the broader direction of change. Toronto's condo market isn't a free fall right now. It's in a slow, logic-driven correction that's resetting expectations and reward to risk ratios. The next Bank of Canada move will likely be another gentle turn of the dial, not a plot twist. If you make decisions with evidence instead of vibes, you'll do fine. Maybe better than fine. And not to get too philosophical, but calm is a competitive advantage in a noisy city. If you're hunting for a place or thinking about selling, reach out to me and I'll send you building level data and a clean plan for your next step. Thanks for watching, and I'll see you in the next one.